You there?
Yep, I'm watching a stream start. Okay, we are on YouTube right now. Welcome, Pat.
Hey, Rick, how you doing?
Can't complain, can't complain.
Get my Wisconsin shirt on.
I'm going to turn something off here for a second, and then we'll be right back on there. Okay. All right, Pat, it's our third update. And last week when we talked, we were seeing some tightening. It was Friday that Chase Bank decided that they were going to tighten up their lending criteria, and they said they wouldn't loan with anybody with less than 20%, and you needed to have a 700 FICO score. But we are seeing lenders that are still lending down to 620 and 640, I understand.
Yeah, we are. I mean, there's you got to be careful. I mean, 620, 640. Like I said last week, all boats rise with the tide. But I think the lenders really, what's happened last week. Obviously, they're still talking about forbearance. Just to give the people an update on the numbers. There was a service called Black Knight out there as of yesterday. Just to kind of put the numbers to, people say, well, how many people are in forbearance? What are the numbers? The numbers that I saw, according to this report, was there's 2.94 million homeowners who, as of yesterday, that entered into a forbearance agreements, basically temporarily delaying their payments or their required monthly payments. And actually that number equates the unpaid principal balance of these mortgages is approximately $651 billion.
But that's only after about 2.5 weeks of this announcement that you could have a forbearance or this crisis, and your April payment isn't actually late until May 1st. So, I mean, you can make your April payment, April 30th, and you're still not late.
Yeah.
So they're applying for forbearance already. That's pretty scary.
It is, but the thing of it is too, though, each servicer's, one thing that people have to realize, and hopefully they get something out of these videos that you and I are doing, rather than just saying, things are, I'm trying to put some numbers to the, rather than saying we got gas in the tank, how much gas do we have in the tank? Trying to put some numbers to everything. But keep in mind, I think what I was seeing too is that if people do go in forbearance, there might be some people out of these 2.94 million that actually are doing it as a precaution. I've seen my buddies who are also lenders, they have been putting out warnings saying, if you can make your payment, do not use this as just a free pass to try to push things. If you can't make the payment, that's going to be your best advice. There's still a lot of question marks as far as, what could happen, what might happen. Bottom line is you have to assess your situation and say, yes, I can afford this. Yes, I do have my job. You just can't use this as kind of a free pass or free punt.
Are you seeing any other options besides forbearance?
Deferment. I mean, forbearance has been really what I've been hearing is forbearance is the number. Forbear till like say July or August, and then when you get to forbearance period, then they might still modify your loan. Okay, you can't pay this lump sum. Then what they might do is modify your loan and put that payment on the end of the loan, after 30 years. But keep in mind, I said a lot of stuff that people are talking about right now are shoulda, coulda, wouldas. I mean, you'd hate to do something that actually down the road said, I should have did this, I should have do that, because nothing is really. I haven't heard. I've seen a lot of hearsay. Yeah, this is what you can do. Call your servicer, because each servicer is going to have probably a little bit different twist on how they look at everything. So, take the short road, make your payment. If you can't, like one of my buddies, Scott Fenner said, he's with another mortgage company. He said, don't use this as a free pass. If this is economically where you can't make the payment and you've got, a payment of $1,500 and you've got, $600 in your checking account, yes, by all means. But if you've got other means of 401k savings, don't do it. Another thing is too, so if you do go into forbearance, you obviously request forbearance. There's probably for some people to keep in mind, if you do go into forbearance and a month later you get your job or get a job, call that servicer. Don't stay into forbearance, because a lot of people will say, well, I got forbearance till August. I'm going to just stay in that program. No, call the servicer. You can cancel the forbearance. It's kind of like canceling a bankruptcy. So keep that in mind. I mean, you might be going along and people might be doing, out of the 2.94 million people that are doing this, maybe some are doing it to obviously be proactive, because it does take a long time to get on the phone and talk to the servicer. But once you get in, you request it. But you could also, as much as you request it, chances are you can cancel it too. And I think that would be, the best thing to do.
I agree.
But like
you
I
also said, and it's important to people to know that you can, they've eliminated the penalty on 401k. So you can pull that money out of your 401k. If you're not 59 and a half, you're not going to pay the 10% penalty fee or any early withdrawal fee. So if you have to pull from your 401k to make a few mortgage payments, that's a prudent move. I
think, I just thought about this. I think there's a lot of people, it's obviously, this whole time frame it's a gut check, and people are, cruising along. And I think, I just kind of popped in my head. There's probably people that have resources that they really haven't even thought about before forbearance. I think forbearance has got to be, your last lender, last resort, because like you said, it's still not a known fact of, it's still going to report on your credit. Even though the lates are not going to report on your credit, there's going to be a little note on the bottom of there's a little area where they can put notes and saying this loan has been in forbearance or wasn't forbearance for this period of time. And who's to say that the lenders down the road, this was happening with short sales, obviously foreclosures back in 07, 08, 09, back at, when people started coming out of it in 2010, 11, 12, it's like, oh, I had a short sale, there's a lot of stuff that's, this is going to be obviously another thing is too, people should monitor their credit. And, I would talk to a lender servicer and ask the servicer how they're going to report this. I mean, because even though they said they can't, you never know. And
don't get your forbearance advice off of Facebook right now. I've seen some real bad advice being tossed around on there. And it's interesting.
Everybody's a doctor now.
I know.
A mortgage expert.
Well,
everybody's a doctor, a mortgage expert, and a real estate expert.
Financial experts. Yeah, all of us. Yeah. So no, I think that you have to go directly with your lender and ask them the questions. There's no way we can say, here's what you do, because I have no idea who your mortgage is through. And, it's going to be
not one size fits all.
Well, now this week, today, listings are, let me look at the accurate number here. Listings jumped to 14,609. That's up 3,500 homes from when I started tracking on March 13th. Still not a huge number. But what's interesting is we're seeing, as expected, there's a couple dynamics going on in the market. Airbnbs are really starting to come on board. I saw one just yesterday. The guy bought it in February for $615,000, and now he's selling it for $619,000 in April. So that tells you he was ready to bank on spring training and having that thing booked in Scottsdale. And that all got squished, and he didn't factor into his budget, what will I do if I'm not renting it out? But the other thing that I've seen that's happening and been reading is that many of these homes that were Airbnbs, investors from around the country are coming in to buy them to use them for long-term rentals. So there's an investor pool out there that's actually quietly bailing these guys out. And so, which makes sense, because rent is still strong and investors still have, the cash to do it, and the return on investment is going to be good. So the Airbnbs are being gobbled up quicker than your average home because they've already got the furniture and they've already got the dishes. So some of these investors are picking them up and saying, hey, fully furnished unit, fully furnished home. And we're getting 4,000 homes coming on the market each week, and 4,000 of them are being sold. But in that 4,000 number are still about 600 to 800 homes a week where the sellers are saying, instead of lowering their price, they're just taking it off the market because they're going to wait it out. And
Mhm.
that might not be a bad play. I mean, nobody really knows how this is going to shake out because none of us have been through a pandemic before, but that's what we're seeing on the real estate side. Did anything besides um, Chase's tightening last week change this week in your world?
Um, I was on a conference call, this Zoom conference call with probably several of the, top industry experts. There's probably about 4,000 people on the Zoom call. And yeah, there was a few things. Basically, what I'm seeing is obviously, well, just in terms of the economy, they're talking about that. Um, they said, obviously, the numbers, unemployment numbers gonna be 20%. Um, he said they figure that the numbers will settle down into 8 to 10% unemployment rate. But in terms of the actual lending reserve requirements, I think people have to be ready to, not have just their down payment, but lenders might require, more. Even though you've got a great credit, they still might require 2, 3, 4 months reserves or 6 months reserves. Like I said last week, on the rentals investment property, a lot of lenders are requiring that you have X amount of reserves, 3 to 6 months reserves for each rental property that you have. So that that's kind of those are tightening. When we talk about, I just
That's a
want to
lot of
clarify.
money.
Yeah, yeah. So you just can't have the down payment. Credit. Yeah, I mean, people call me and say I got great credit. I said, well, that's just a start because you have to have great credit, down payment. Now they're looking at they'll probably start digging into reserves. One thing that I often refer to, and I want to clarify, um, people for the average person is you always hear maybe they heard the terminology overlays. What are overlays? Um, and this is for the average person that they might be, when they're talking to a mortgage person, they say, well, there's some overlays on this loan. What that means is basically Fannie Mae and Freddie Mac have a certain set of guidelines, and they're just guidelines. They're not rules. Like I said, a good lender, a good mortgage person will take those guidelines, and you can I'll certainly provide one piece of paper versus another piece of paper to, help offset that guideline. But each lender, ABC lender, Fannie Mae and Freddie Mac have their guidelines, but then each lender might have their own guidelines to help protect them. There's another extra layer of risk, and that's what they call overlays. When you hear the word terminology overlay, you get the Fannie Mae, Freddie Mac guidelines, and then you've got an overlay. And, ABC lender might have another overlay, where for say Freddie Mac might have a reserve requirement of three months. And one particular and overlays, obvious, they actually vary from lender to lender. Some lenders are more strict, are going to have more overlays than others. So, but another lender might have a reserve requirement of 6 months versus 3 months. So each bank, and that's why, when you get a loan, you often hear you as an agent say, well, I had this client go to these two banks. I just did a loan 4 months ago that this lady went to 5 different banks. And she came to me. I went through another program, got the loan done, and she still was questioning me till the day about a week before closing, saying, I don't know how you're doing this because I had 5 other lenders that said they couldn't do this. So each bank has got different overlays, and I kind of went in between the cracks, in between the overlays, and got the deal done. I mean, I did it. Everything was obviously above board, but there's certain things in overlays that you can kind of read between the lines. So but I just want to kind of clarify what overlays are, because people will probably be hearing that a lot, because the overlays are going to change from week to week. Right now, the overlays are tightening. They say, going back to that conference call, there's still a lot of confusion on the mortgage-backed security market because, obviously this forbearance, this is still, we're only, it feels like this, we've been doing this, we've been in this for like the last 5 years. It's only been 30 days, 45 days. So there's still a lot that has to go through the system, and the credit availability. There's Mark Calabria from the FHFA, the Federal Housing Finance Administration, has been giving a lot of pushback to helping the servicers, which is still causing a lot of commotion of how the servicers are going to still get helped out. And that goes back to what I was saying about the forbearance agreements. The unpaid principal balance of $651 billion. I mean, that's 0.6 of a trillion. So we're getting, I mean, and that's just, we're into 30 days. Like I said, I don't know, who knows how many of those forbearances will come to be forebore, so to speak. But, maybe they do, some of those are canceled once people get, maybe people are being proactive. But there's going to be, there's a lot of commotion still behind the scenes. The financial ecosystem is still a little suspect. The pricing on interest rates right now, there's still, lenders are pricing in for volatility. So I'm kind of frustrated from the fact that I don't think Mark Habib thinks that rates, once they settle down the next 2, 3, 4 months, that we're going to see, he doesn't have a crystal ball, but he thinks rates will float back down in the high 2s, low 3s. They've been, depending on what lender we go to day, lenders have been switching their pricing. And one day they're at 3 3/8, the next day they're at 4 because they have too much business coming in. But the financial ecosystem, like you said, has been disrupted, and they see it accelerating at a faster pace right now. They feel that there will be a wave of defaults once we get past this forbearance period. Barry brought up a very interesting thing, though, that I've been doing it 30 years. Not that it means anything, but you do get, like you've been around. You start to see certain trends, like we talked about, trends, data, data trends and psychology. I really believe that based on all the information that I've been reading, people are saying that we're going to see this V recovery. And he said something on the conference call that really struck my interest. Is that, and there's another gentleman, he said, I think we'll see more of a W-shaped recovery, where we got the down, we're going to see it. Obviously the next couple of weeks we see people getting back into the market, unemployment, and then I think you're going to see still that restaurants, they said there's going to be over 100,000 restaurants closing permanently. And then I think that's going to be another down. So it might be more of a W-shaped recovery than a V-shaped recovery, because a lot of people are expecting,
that makes sense. But it can't remain growing at the rate it was if your unemployment rate was 3.5 and now it's 6 to 8.
Yeah.
I mean, that's simple math. The other thing to watch out for too is we get what's called armless stats report on our email, which is an Arizona regional multi-listing service. Well, those numbers are useless because it's all last month, and it's showing you active listings, sold listings, list to sell ratio. And I told the client yesterday, I said, it's impossible to comp a house right now, because normally I go back and look at 3 months data. It doesn't matter now. So you just kind of have to wing it, test it, and see what happens. Because the only thing that matters is the price of the house that you decide to start with, and you put it on today and you wait for 3-4 days. And if you're not seeing traffic, there's your comparative market analysis. It's going to tell you right then and there.
Everything is lagging.
We're seeing traffic. I mean, there are people that have to buy, and there are people that have to sell, and they're meeting in the market. So it's happening. But I don't see, and there's even certain price ranges where there's still some, bidding going on in the low 3s in places like Gilbert. So, the market's not dead, but we're just kind of, I don't know. I just think like we're kind of hanging on a cliff. I don't feel like we're going to have a true collapse or a bubble, but there's certainly a lot of crap going on out there that ought to make you, watch it very closely. Would you agree?
Yeah, no, I agree. I think, like I said, we got to compare. The only thing we can compare is back in 07, 08. And like we talked about last week, is that, there were so many dynamics that were different than, now than they were then. One thing that they were talking about on the conference call today, obviously I listen to these conference calls because, these guys are experts and they've been around, they talk to a lot of people. So rather than just reading, the USA Today and making an opinion, that's why, I feel like and I do read and study this stuff, and you try to read as much as you can and take that opinion. Nobody's got a crystal ball, but you form take the data and the trends and you make the psychology. And they said that, there's still pent up demand. One thing that we do have going for us is we do have that millennial market now, the younger generation that we did have back 10 years. That was 13 years ago in 07, 08. These guys were, that were, 15, 16, 18 years old. Now they're 30 and 31. They're looking to buy a home. So they're in this area. Obviously, like you said, that real estate is somewhat geographically, we could have a great market in Phoenix where up in, Boise, not Boise, Idaho, but up in my hometown, like say Oshkosh, Wisconsin is going to be different, but there's still a lot of pent up demand. Even in Wisconsin, there's people looking for homes. So I think the supply, that's where you're seeing that, sellers and buyers, there's that back and forth because there still is that demand. I mean, we do have a housing shortage right now. We had a housing shortage back, a couple months ago, and that hasn't changed. So I think that's going to keep the demand.
No, it's funny. I was looking at a neighborhood that I tracked down in Chandler called Ocotillo, and I did my February market report on Ocotillo, and I was highlighting that in this defined area of Ocotillo, there were only 28 homes for sale. That was it. It was alarmingly low. Now it's been hanging at 52, 53 for 3 weeks. And it's not the same 52 and 53 homes. They're going on and coming off, but it's steady. And we're selling about 7 to 9 homes a week. So they're still a 2-month or less supply of homes. So there's stuff going on. And that's the past 2 weeks. So that isn't that March data I was talking about. That's really what's going on right now. So there's stuff going on. I just, it's going to be interesting to watch. So what are we going to watch for next week?
Well, actually the Fed, one thing that, I think rates have stabilized. Rates, I've been watching rates today. Actually, the bonds got hit a little bit because the Feds came out 2 weeks ago, and obviously they've stabilized MBS, the mortgage-backed security market. They basically they're purchasing about $50 billion dollars a day. They actually did update their buying schedule here today, and they said they're going to be cutting that from 50 billion per day down to about 30 billion. And actually, I think it's going to be they're talking about cutting that down even further. So they're going to cap. I guess they're going to cap the buying at 15 billion. So they're slowly trying to get out of that market right now. So I think we're going to see rates, act a little bit more, not as artificially as they have been. And they say that, and I think once they get out of the way and you see the economic numbers, I think the economic numbers are going to bear, I think people are going to know that they're going to be bad, but if they are a little bit worse than that, I think you're going to see the market, the rates dip, further, a little bit further. And because a lot of the lenders right now, they've been busy since end of February. There was a lot of locking, interest rate locking going on the first week of March, and for 30 to 45 days. And ironically, it's about 45 days. So now these lenders they're cleaning through their pipeline. They're not as, they got that stuff locked. So they're going to be out looking for new business. And like I said, the hedging, that's where they got burned by the hedging because they had a lot of loans. The Feds came in and bought these mortgage-backed securities markets, which increased the price from say 100 to 100, 105. And when the lenders, when they hedge, they expect those mortgage-backed security markets to go down from 100 down to say 95. But that's what really burned a lot of lenders is that the prices, when the Feds came in, that's what they were saying is the Feds coming in and buying actually hurt a lot of lenders because they were hedging that, like I said, the bonds going from 100 to 105. I'm just throwing numbers out. The lenders themselves, when they're hedging it, are expecting, they always buy the opposite position, expecting to go from 100 down to 95, but they went to 105. So that's where they got burned. Now that all that stuff is in the foreground now. So I think things are going to stabilize, but now it's going to be waiting to see what numbers. I think they're going to be worse.
So that's just another example.
Credit's tight. Bottom line is credit's going to be, people just have to get all their ducks in a row. Things haven't changed from 6 months ago. Get your ducks in a row, see where you're at with your credit wise. You're just going to have to be probably a little tighter, your credit score, make sure your credit score is higher. Like I said, everything is kind of compressing and it's going to be, week by week. I've never seen a market where you got to just kind of watch it week by week. And, and there's another point that these guys made on this conference call is don't listen to the cowboys. You got these lenders out there that say, no, we could still do, credit scores from 620 and below. That's a cowboy. They're shooting from the hip. And because like I said, the opposite, what I'm seeing is that, if you're 680 and above, you'll get it. So, and the pricing is the volatility, I think, in interest rates, I mean, has been priced into the rates. I think you're gonna see that volatility premium shrink. So the pricing will get a little bit better from, day to day, intraday, pricing on interest rates, but guidelines are changing, like I said. And they'll tighten, they're going to tighten for the next 2, 3, 4, 5 months. And then I think eventually they will loosen, but nothing's changed. It's just that you got to be, you know, cognizant and, when you're going to a lender, some lenders price really well. And this is another thing that I've been, another lender I was watching, Jeremy, I agree with him there, is that I might have an investor that prices really well. Like, oh my God, that's the interest, they're the best price. Cause I've got a list of 30 investors I can go to. Being a broker, I can take one credit report and shop the loan to 30 investors. So people don't have to call investor, bank A and bank B and bank C. I could do it all in one shot. But what I'm seeing is the investor that is the best price, they might be the slowest because they're busy. So remember I told you in that last video last year, there's rate, speed, and service. Pick 2 out of 3 because you can't have all 3.
Yeah.
And if you want the best rate, you might be 7, 8 to 10 days in underwriting. So it's that's
going to be interesting to watch.
That's one last thing before I go. Before we go on, all right, you cut me. I know I get chatty, but that's where, like I said, talking to somebody, whether it's, obviously me or somebody that's been in the business that knows versus calling a call center and getting the best, you go to these call centers on the internet, you're going to be talking to Joe Smith, who just got in the business. He's at a call center. He's not going to give you any guidance. And that's where I think, like working with you, a guy like me that's been around, I don't give you, we always say, maybe not give you perfect advice, but we'll give you good guidance and counsel.
Yeah. I think this is the time and market where you got to be really careful with the newbies. And it's not, and you can have somebody that's very new in real estate, but they may have a strong background in just analyzing statistical data or just living life. And so you want to, I'm always scared and a little wary of the person that's just always pumped, ready to go, using words like crushing it and killing it. Because, you can crush it and kill it all you want, but sometimes you've got to look out for people and sit back and tell them what's really going on. So, we're going to be doing these updates every Friday at 3:00 live, and they're recorded so you can go back and watch them. But if you have any questions or anything and you're watching out there and you want us to answer it, put it in the comments below and tell us, if you think we're all wet, and or let us know what you think, what you'd like to know next week when we come back on, and we'll be sure and answer it. And we'll also answer it for you in the comments as well. So Pat, thanks for reporting in from your bunker.
Yep.
And even
Wisconsin football bunker,
nothing but Wisconsin behind you.
Yeah. Exactly.
Yeah.
So, got my Wisconsin shirt.
Holy cow! I'm kind of
proud of University of Wisconsin Badger in economics. So
I'm on the 4th floor, and I decided to be the old man in the tower, and I now have a scepter. I welcome the peasants when they come home from out of the balcony. So, it's all about being prepared, and I have help. So I have 2 scepters.
There you go.
Yes. All right, Pat. Chat at
Thanks,
you later.
Rick. All right.
Thanks.
Have a good one, buddy.
See you.
Ciao.